Small business budgeting. 8 different formats you can use depending on the company's goals. Remember that every company, large or small, must track its revenue, cost, and profit over time, and budgeting remains an effective way to gauge the business financial status. Learn how the small business or large organization, for that matter, can use customized budgeting for both external and internal reasons. Check out the 8 different budget types that you, as a business owner, may use to move your firm forward, depending on operational requirements. Welcome back, folks, to another edition of Sweetie Kiwi. I'm just doing fantastic today. I hope you are doing marvelous. If you're doing as great as I am, go grab a cup of coffee or tea or vodka. Now let's roll. Today we are talking about small business budgeting, 8 different formats you can use depending upon the company's goals. Now let's first, before we even talk about the 8 budget types, let's talk about the need to create a business budget and how you do that. Now, if you don't have any familiarity with finance or accounting or budgeting, I would strongly suggest that you reach out to a specialist, an expert. This could be a CPA, a certified public accountant. It could be just a regular accountant with experience in the field. It could also be a tax accountant. It could be a budget planner. It could be anyone who has expertise, anyone who has a knack for numbers can do the trick very quickly. And anybody who has also experience in the particular sector your small business is in. All right. You want to have somebody to help you develop the necessary financial plans. Now, if you have the expertise yourself, go ahead and do it. Now, a lot of small business have the misconception that if they have a good accountant, that's all they need. Yeah, but remember that accountants, as I said earlier, you need someone who has experience in the field because you have different kinds of accountants. Some accountants are focused on recording what happened in the past, then planning for the future, right? So you need to supplement your accountant's work with a budget analyst or another financial planner who can properly identify potential opportunities and challenges that could arise in the future, right? Now, so if you don't have the resources of the budget to create a business budget, you can basically outsource you can hire a consultant to take care of that. You don't need to have a full-time CFO, chief financial officer to help you with that. No. Now, when it comes to budgeting, you need 4 budgeting systems that you can create. There's something called traditional budget. Now, a traditional budget is created for a period of time and uses the previous year's numbers as a starting point, right? So you can say, last year we made $1 million in sales. So this year we're starting with the same amount, and we'll compare what we did during the year versus what we had at the beginning of the year, right? So if at the end of the year we have 1.2 million, this would have been a 20% increase. The same applies for expenses. So expenses could be at 800, and if they jump to 900, then you have a 100,000 increase throughout the year. So that's for the traditional budget. You also have something called zero-based budget. Now, with a zero-based budget, a business generally is starting from scratch. Now, with this approach, we're not going to rely on last year's budget. We're going to start from zero. So what you're saying is, you know what? This is January 1st, January 2nd. We have no money. The bank, we're just broke. Now let's start from here. If we are planning to sell, say, $500,000 worth of merchandise this year, and we're planning to spend on cost of sale and other operational expenses about 300 grand, right? And then you move from there. Now, a lot of companies will do the zero-based budgeting. They will apply that model every month. So it's like pay as you go. They're not doing anything for a year because 12 months is a lot of months. It's a long time for certain businesses, that especially those that are in the cyclical markets where the activities is seasonal. The relationships with suppliers and vendors have to be constantly renegotiated, right? So when you have uncertainty on the operational field, you need to do things on a monthly basis. So a lot of small businesses will use the zero-based approach, the zero-based budgeting approach on, I would say, on a monthly or quarterly basis. The third category when it comes to business budget is flexible budget. Now, as the name implies, a flexible budget will change as the sales forecast is adjusted. In practice, the way it works is that you would start with the sales, and then you will basically calculate every budget item as a percentage of the sales number. Simple example. Let's say you plan to have $1 million in sales this year. As a small business owner, you are very bullish on the industry, and you believe that you will be making $1 million in revenue this year. You can say my cost of sales will be 60% of the revenue. My operational expenses, this is like, things like payroll, utilities, suppliers, logistics, transportations, entertainment, meals. Those will constitute 20% of my sales. I plan to pay taxes 10% of my sales, and then my profit will be 10% of the sales. That way you are actually labeling everything as a percentage in relationship to the sales. That's what a flexible budget is. And then you have something called a rolling budget. Now, a rolling budget ensures that the organization is looking a year in advance, right? As each month or quarter ends, it drops out the budget and a new month or quarter is added. A rolling budget is very good if you are new, if you are a startup, you get into an industry where you have no visibility beyond beyond 3 months or 6 months. If you are in an industry that is highly regulated, or the regulation field is very uncertain. Let's say you are a small startup in the biochemical industry, and you're working right now on a pill or on a molecule for which the FDA, the Food and Drug Administration, hasn't issued has never issued a decision in the past. So there's a lot of uncertainty, right? So you want to use a rolling budget in this case, because you can drop off the budget of the previous period and roll a new budget every month or quarter, depending on the situation. Now, remember that business owners need multiple budgets, and each of those budgets serves its own purpose. And small business entrepreneurs must also choose between several ways to set up each one. Okay, let me talk to you about the budget data, how you need to tie your budget data to financial statement in the second section. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. In this show, I'm talking to you about 8 different formats of small business budgets you can use depending upon the company's goals. Before I talk about the different formats, it is very important to understand what a business budget is. I spoke to you earlier about how to create one or get help in creating one. Now let's talk about the importance of tying your budget data to your financial statements and vice versa. Financial statements are the backbone of your company. Financial statements are they provide real-time data, real-time status info, real-time status updates about your company. Now, there are 4 financial statements broadly. You have something called the balance sheets, also called the statement of financial position or statement of financial condition. Then you have the cash flow statements or the statement of cash flows, the income statements, also called the P&L or the profit and loss statement, and then the statement of owner's equity. Now, there are 3. The statement of owner's equity is not really it doesn't serve that much when it comes to budgeting, because part of it is that statement is also lumped into the balance sheet. So in practice, for budgeting, a lot of small business owners and experts will focus on 3 financial statements: balance sheet, cash flow statements, and income statement. Now, when it comes to the balance sheet, the reason why you need to analyze your financial statements before doing a business budget is that those items that constitute the financial statements will also be replicated partially or fully in the budget. So on the balance sheet, you want to pay attention to short-term assets. So everything from cash, from accounts receivable, prepaid expenses, right? You have also capital assets. So if you plan on spending money on property, plant, and equipment, that will go into the budget, and you can get more info about that by looking into the balance sheet in the capital assets section. Capital assets are also called long-term assets, and those are assets that you will hold for more than a year. That's the accounting terminology here. You have short-term debt. Short-term debt is debt that you have to pay within a year, and long-term debt is debt that you can pay. Debt whose maturity is above 1 year. So basically, the thing here is that you also have things that you have to pay attention to when it comes to business budgeting. You have the off-balance sheet items. For instance, if the owners has given a guarantee on another loan, in other words, the owners has co-signed on another loan, or the owners has like the company has borrowed from a bank, and the owners has to co-sign or provide some kind of collateral. You put those things on the balance sheet, but they're called off-balance sheet items. They are in footnote disclosures. You also have contingent liabilities when it comes to, for instance, if you have a lawsuit that is looming over the company, the court hasn't decided yet, but the company thinks they might be paying some they might be liable for something. You have some kind of contingent liabilities. This you can put in the balance sheet or outside, but we're not going into accounting technicalities here. My point here is that there are items on the balance sheet that you need to pay attention to as you construct your business budget. Another thing you want to pay attention to, the second statement, is the statement of cash flows. There are 3 sections in that statement. You have cash flows from or used by operating activities, cash flows from or used by investing activities, cash flows from or used by financing activities. Now, operating activities constitute everything that happens during the day-to-day operations of the company. I'm talking about payments from customers, payments to suppliers, salary payments, taxes payments, anything that constitute the operation of the company will flow into operating activities. Then you have the investing activities. Investing activities will focus on the purchases of capital assets. If you remember earlier, I was talking about capital assets. So if you buy property, plant, or equipment, this will go into investing activities. If you also if the company, your small business, is also making some investments on the stock market or financial markets in general, that will flow into the investing activities. And the third category is financing activities. So if you borrow, that will be a cash flow from financing activities. If you issue stock, you get, if you have new shareholders in the company, or if you pay dividends, all of those things will flow into the financing activities category of the statement of cash flow. The third statement, and again, the reason why experts want small businesses to pay attention to the financial statements, again, as I said earlier, is that data in those financial statements are replicated in a traditional business budget, and vice versa. So you see those data in a budget, and you can trace them from the budget to the financial statements, and vice versa. So it's very important. The third financial statements that you need to pay attention to when building your business budget, your small business budget, is the income statement. That's also called the statement of profit and loss. Some people call it the P&L. So in a normal P&L, you have sales, right? Cost of sales, the gross margin. So gross margin will be in relationship with the sales and the cost of sales. It's because gross profit is sales minus cost of sales, and gross margin is the gross profit divided by the sales amount. Then you have the operating expenses. I think I talked about that before, and the net profit. So by looking thoroughly into items in those three financial statements, you'll be able to find the data you need to build your business budget. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having a wonderful conversation today around small business budgeting, 8 different formats you can use depending on the company's goals. So I've given you in the last 2 sections, I've talked to you about how to create a business budget and how to tie your business data to financial statements. Now let's talk about the 8 types. You want to choose the best budget type for your business's goal. Now, the degree of complexity of budgeting can vary depending upon the size of the business, but there are 8 common types, and let's just quickly go through them. You have something called the master budget. This collects and aggregates information from a business's other budgets. In other words, let's say you have 3 or 4 different budgets, and all of those budgets are lumped into one. And this is the master budget. It allows you as a business owner to have a bird's eye view of the company's revenue and expense forecast for the coming year or quarter or 6 months or even 3 years, right? It provides a big picture look at your firm's expenses and revenue. Now, if you have a larger organization, let's say you are making 10 million, your company is making between 10 and 100 million, so you kind of qualify for a mid-sized business, a master budget will be very helpful for managers to see how the division fits into the overall business, right? Let's say you have 500 employees and all those employees are categorized into, say, 20 departments. Every department head can look into the master budget and say, oh, okay, here is our contribution. Here is where we need to work harder. Here is our overall position within the company in terms of budgeting. So that's what the master budget is for. Second type, operating budget. This is what people usually think of when considering business budgets, right? So an operating budget will estimate revenues and expenditures for a certain period of time. So a small company can compare its actual results to the operating budget as part of regular reviews. So if you use the operating budget properly, you can track the progress towards the stated goals of the company and makes course correction as required, right? So operating budget is the budget that everybody thinks about. So at the beginning of the year, you just kind of have a template where you put numbers in, and at the end of the year, you compare actual numbers versus the budgeted numbers. Third budget type, financial budget. Now, financial budget generally look beyond revenues and expenditures and fold into asset, liability, and stockholders' equity. I think I spoke about that before. So to do a financial budget, you got to grab data out of the balance sheet. And this will provide a clearer vision of your business's overall health. Now, a financial budget is mostly important when you are seeking funding, whether you want to borrow or you want to do an IPO, an initial public offering, you want to do a merger, you want to bring a silent partner on board. Whatever it is, you need to have a financial budget as part of the due diligence process. Next budget type, you have the cash budget. Now, cash budget is also called cash flow budget, and this blueprint estimate how much money will pass through a business in a given month, quarter, or year, right? The thing here is that you never want to run out of cash, okay? Because the cash budget helps your company know whether you can meet your immediate obligations, and if a loan or other financing might be required to pay for upcoming expenses. Right? Because the bottom line here is that when you do an operating budget or a master budget, you are projecting expenses, and some of those expenses really are rolled over or paid over a certain period. They're not due right away. But if you do a cash budget, you are focusing on those items that need to be paid right away. For instance, a lot of if your insurance policy is paid 1 year in advance, right? So it is paid at renewal, even though for the purposes of an operating budget, you might divide the annual amount of the annual premium amount into 12 to get the monthly amount. But when it comes to renewal, you need to pay upfront if that's the agreement you've had with your insurance company. So you need to put all those things in a cash budget. And as I said earlier, a cash budget can be done very easily if you have the statement of cash flows in front of you. Hence the importance of tying the data from the budget to the cash flow to the financial statements and vice versa. Next budget, labor budget. A labor budget is important for any business that has employees. Well, all businesses have employees unless they're sole proprietors, I guess. So you can use a labor budget to evaluate how many workers are needed to achieve the desired level of production, and then you can plan the payroll cost of those employees, right? In addition, a direct labor budget can be helpful to prepare for the expense of seasonal workers. We've seen in our research, we've seen that labor budgeting has been very effective in the farming industry, for instance. A lot of small businesses, a lot of small contractors or subcontractors in the oil and gas sector also use labor budgeting. Activities where seasonality is important also use labor budgeting. I mean, the attraction parks, any events, any summer events for kids, around vacations, around any events around students. Event planners also use labor budgeting a lot. Next budget is a capital budget. A capital budget is how a small business plans for purchases of large assets such as machinery or a new building. So this blueprint lays out not only the cost of the asset but also the expected payback period and whether the potential return on investments justify the purchase, right? This is, if you remember what I was telling you earlier, you look at the balance sheet and there's a category on the statement of cash flows called investing cash flows, right? So this will tie into the capital budget. You have the next budget is called the strategic plan budget. Now, this is very typical for businesses that have that they want to create a vision for the future. Now, remember, this is not a budget for you to use to run your business on a day-to-day basis. This is more an idealistic, a vision-based budget, right? So a strategic plan budget is more conceptual. You can put at a minimum actual financial information, but you're actually basing everything you're basing things on the future, on your expectations of the future of the economy, or of macro and micro economic factors here, right? And it is, if you think about it, the best way to think about it is a strategic plan budget is a practical roadmap for how a small business wants to grow in terms of sales and acquisitions to achieve its goals. And the last, number 8, the last budget is called a static budget. So some businesses, particularly those with predictable sales and expenses, create a static budget. So generally, this kind of budget doesn't change throughout the year, and it can be used to spot variations between budgeted and actual line items. And many businesses find a static budget useful for gauging sales performance. All right. So this is it, folks. It really, I love this kind of conversation. I really hope that you learn a lot as we did, as the whole team did when we were preparing for this show. Kind of gave you a quick recap here. the 8 different formats to use depending upon the company's goals. So I first spoke to you about creating a business budget, about tying the budget data to financial statements, and then choosing the best budget type for your business's goals. Now the 8 types are master budget, operating budget, financial budget, cash budget, labor budget, capital budget, strategic plan budget, and number 8, static budget. Thank you so much for listening. I really appreciate your attention today. I will see you next time, but until then, stay marvelous.